Next department, Claim Settlement Department. This department is also very important because we know that the purpose of insurance policy is to provide insurance amount when a loss occurs. The claim process begins with a notice of loss. When an accident happens, you suffer a loss, you need to notify your insurer as soon as possible. In the insurance company, some people will start to investigate this insurance claim. These persons we call them claim adjuster. Claim adjusters need to make sure that a loss really exists, an accident really happens, and the insurance policy covers this loss. So they need to review policies. They need to examine the records to see whether this is an intentional loss or not. If it is an intentional loss, the insurance company doesn't need to pay the related amount. Or if this accident is an exclusion, the insurance company also doesn't need to pay. And sometimes they also need to negotiate the settlement amount. Since claim adjusters need to investigate the claims, they may need to travel a lot. Go back to our lecture notes. Claim adjusters need to investigate the claim, determine the amount of loss, and arrange for the appropriate payment. And the basic objective in claim settlement include first, verify that the loss is covered. If the loss is not covered, the insurance company doesn't need to pay the insurance amount. Okay, so it's good for the insurance company. In contrast, if the loss is covered, the insurance company wants to pay the claim fairly and quickly. The insurance company also wants to provide personal assistance to the insured. By providing better customer services, this insurance company can attract more potential customers. As an insurance policyholder, you need to cooperate with the insurance company after a loss. Otherwise, your insurance company can reject the insurance payment. Let's see this case study. Homeowner's failure to cooperate yields denied claim. In 2009, Joseph purchased a homeowner's insurance policy, and this policy was issued by State Farm. And in August 2010, Joseph's house was destroyed by a fire, so he submitted a claim. State Farm's claim adjuster investigated this claim and asked Joseph to provide some financial records. However, Joseph failed to provide the requested financial documentation. Finally, the claim adjuster found that Joseph owed the IRS $391,000. And Joseph intentionally destroyed his house. State Farm concluded that the house fire was the result of arson. In this case, the judge concluded that State Farm didn't need to pay the insurance amount. The reason is not because it's an intentional loss? It's because this policyholder, Joseph, didn't cooperate with the insurance company. In other words, the insurance company doesn't need to prove that this is an intentional loss. As long as you don't cooperate the insurance company to investigate a claim, the insurance company can reject the insurance payment. Next department, reinsurance department. Reinsurance department is an interesting department. We purchase an insurance product because we don't want to suffer some risk. So we transfer this risk to the insurance company. What if now this insurance company also doesn't want to take this risk, but they also want to sell this product? This insurance company can transfer this risk to other insurance company, and this other insurance company, we call it reinsurer. And the process, we call it reinsurance. Reinsurance means the primary insurer transfers to the reinsurer part or all of the potential losses associated with such insurance. For example, an insurance company issue an insurance policy today, and the policyholder pays the insurance premium $100,000 today, to get the 1 million coverage, insurance amount $1 million. However, now this insurance company doesn't want to take full responsibility. Suppose this company only wants to take 40% of the risk. So what can this insurance company do? This insurance company can find a reinsurer and transferred 60% of the premium to the reinsurance company. The remaining premium, $40,000, we call this amount net retention. We keep this $40,000 in our insurance company, and we transferred the other $60,000 to the reinsurer. Reinsurance companies usually are very big companies, such as Swiss Re or Munich Re. Now, suppose an accident happens, the policyholder files the insurance claim. The insurer will notify the reinsurer that, well, now we need to pay $1 million to this policyholder. The reinsurer will give the insurance company $600,000, and the insurer will pay the remaining $400,000. So in total, the policyholder will get this $1 million. In practice, the policyholder doesn't know whether the insurer is involved or not. The policyholder only knows that the insurance company pays this $1 million. And in this case, the insurance company, the original insurance company, we also call it a ceding company, because this insurance company ceded some business to the reinsurer. Let's go back to our lecture notes. So ceding company means the insurer that initially writes the business. And the reinsurer means the reinsurance companies that accept insurance from the ceding insurer, from the original insurance company. Net retention Net retention means the amount of insurance kept by the ceding company. And why some insurance company wants to transfer its risk to the reinsurer. The first reason, the insurance company wants to transfer the catastrophe risk to the reinsurer. Some insurance company fears that it suffers too much risk, and one event may result in a catastrophic loss. So this insurance company decides to transfer some risk to the reinsurer. The second reason for reinsurance is to stabilize profits. Since the insurance company transferred the catastrophic risk to the reinsurer, once a catastrophic event happens, the reinsurer needs to pay the most portion of the claim payments. So it helps to stabilize the insurance company, the original insurance company's profit. The third reason is to reduce the unearned premium reserve. We know that once the insurance company collects insurance premium from the policyholder, the insurance company needs to record the reserve. Okay, reserve represents the money the insurance company owed. Reserve represents liabilities. Now, the insurance company transferred some liabilities to the reinsurer. So now the reinsurer needs to record these liabilities. In contrast, the insurance company can record less reserves. The final reason, to increase underwriting capacity. Since the insurance company transfers some risk to the reinsurer, now this company can take more risks. This company can sell more insurance products. Indeed, in the insurance market, some insurance companies' goal is to sell more insurance products to have higher insurance premiums per year. Their goal is to increase the market share. But you know that sometimes higher market share doesn't mean higher profits. In this chapter, we will learn two types of reinsurance. The first one, quota share. Under a quota share treaty, the ceding insurer and the reinsurer agree to share premiums and losses based on some proportion. Actually, you already know how to calculate the quota share amount. Let's see an example. Assume that Apex Fire Insurance and Geneva Re enter into a quota share arrangement by which losses and premiums are shared 50-50. Okay. In other words, if the insurance company, the Apex Fire Insurance Company, collects insurance premiums from the policyholder, this insurance company will give the reinsurer 50% of the insurance premium. And once a loss happened, the reinsurer pays 50% of the loss, and the insurance company pays the remaining 50% of the loss. Suppose now a 100,000 loss occurs. The original insurance company will pay the policyholder $100,000. And this insurance company will be reimbursed by the reinsurer, okay, the Geneva Re. and the amount is $50,000.